This is episode number 59. In this episode, I'm having a conversation with Sascha Berger, partner at TVM Capital.
That even if a decision can be made quickly, typically there has been some sort of pre-warming before, and people have spoken and have validated things. So
Dr. Sascha Berger is a partner at TVM Capital based in Munich, Germany. TVM Capital is one of the pioneer transatlantic life science venture capital funds with European and North American teams. In this episode, we talk about how the life science ecosystems evolved in the United States and in Europe, TVM Capital's investment approach, how to reach out to venture capitalists, and much, much more. I hope you enjoy the conversation the same way as I did. Enjoy the show. Good morning and welcome to another episode of the Life Science Get Together podcast. And today I am very happy to have Sascha Berger online. Welcome to the show.
Super. Good morning. Thanks for having me, Christian.
Sascha, I always thought that the venture capital investment model is rather a fixed model and doesn't change. And the Sequoia article that I read recently, which stated that Sequoia changes their fund structure into an evergreen fund, and it created a lot of fuss on many podcasts like the All In podcast. It reminded me that it's not fixed. So it also has evolutionary processes and evolves with the ecosystem. And that's why I thought it would be great to learn more from you and your fund. TVM Capital is, in my opinion, one of the oldest funds in life science that is still active today in North America and in Europe. And it would be great to start with giving a little bit of background to TVM Capital and what you are doing in the fund.
More than happy. And actually, it's a very good intro, given that the industry is evolving, and so also funds have to adapt to it to a certain degree. And I can speak not necessarily all out of personal experience, given that TVM is longer in the business than I am. But also we have gone through different waves of what we focused on and how we structure investments. So I was also very, very curious to see what Sequoia was doing. But maybe first, let's speak a bit about TVM indeed. So
yes.
You're absolutely right. We've been around for a long time. TVM was founded in the early 80s here in Munich, where I'm still based, and I'm a partner with TVM. I started as a generalist investor, as many funds at the time. So investing broadly, not just in life sciences, but also in tech and other opportunities. And then in the 90s, we realized that just these broad investments don't make any sense. It's very distinct and different business models and qualifications also of the team you need. So we separated teams. One was more focusing on tech investments, the other more on life sciences investments. Unfortunately, the tech team didn't survive, given that most of the money of one of the funds was invested in early 2000. And as we all know, that was not the best time for making great returns, because just half a year later, basically the entire portfolio was
unfortunately,
was crashed. So, but the life science investments always worked. So here we are today in 2021. Investing out of a $500 million fund, compared to what some of the peers are fundraising these days. This is considered small, I have to say, but it's a sizable fund, and investing in North America and Europe in a very specific manner. But happy to talk about that later.
Yeah, it's very interesting how much money is flowing into the industry currently. I think almost every day I read another great story of companies that closed the fundraisings with hundreds of millions, and also funds sometimes publish that they receive billions. to invest, which I think it's very interesting, because when I started with my Life Science Get Together network to raise more awareness that venture capital is still much needed in Europe to evolve the industry, the numbers were quite small back then in 2010 to 2017. Yeah. And also the ecosystems were different. How does TVM perceive the ecosystems in the US and in Europe over the last decades? What has evolved in life science, in your opinion?
Well, things got more sophisticated, I'd say. So that also allows different strategies to pursue as an investor, so as a company. So initially there was, I would say, one path how to succeed create a biotech company, then try to IPO it at some point. Alternatively, that doesn't work, then sell it to pharma. And over time, different models have evolved. So nowadays, yes, it's still platform plays are super en vogue again, given that also the COVID story and the vaccine development show that new platforms like the mRNAs can have a significant impact and can be financially attractive, of course, also. Mm-hmm. So platforms are still again on vogue. On the other hand, you have specialty projects where a single asset is pursued. That is what we focus on with our fund. Not necessarily the platform play, but really trying to move one individual clinical candidate quickly into the clinic, into a clinical proof of concept, and sell that on to pharma. To build their pipeline. That is a valid strategy. Then you have companies who are really being baked very early on with a lot of money, basically out of academia, with 50 million or 100 million. Then if one of those killer experiments do work out, then they get a lot of money to build a whole franchise around an idea. To potentially go public at some point, and many different forms. So I would say there's not just one path to success. There are multiple ways of advancing science and becoming bigger. The common denominator is it's all costly indeed, and there's a lot of money. Which is available indeed, also partially driven, I think, by COVID and the general reception of the public that you can earn a lot of money here in the field of healthcare, and so I really see investors moving into the space who have previously only looked at technology investments, where it was proven for the last 10, 15 years that you can earn a lot of money, of course, with Facebook and Google and the likes. But this is now also, I think, en vogue to invest in life sciences.
Yeah, I think it's on vogue since last year to also move in that direction. I get also more and more interest from my network from people who have not invested in life science before and want to understand better how the industry works. So this is one reason why I set up the podcast, to open the doors to life science and get professional people like you here to explain how they see the industry and what the touch points are. I think the evolvement, what you said, of the venture capital industry is very interesting. And when I got my training in merger acquisition, it was not life science, but in the other industries, it was always about long-term build companies. Mm-hmm. Then I moved into life science. And in 2008, we had another crash. You mentioned the crash in 2000. And everything went in a direction that you explained, that is the model of your fund, that you look more towards single asset investments. Mm-hmm. And this was also the reality that I perceived over the last probably 5 to 10 years, especially here in Europe. And since the pandemic, and I think also in 2019-20, the models changed a little bit, that more and more funds started came to my awareness that they start looking for technology or for platform technologies to build bigger stories and to create IPOs, especially in the United States. Do you have the same perception about the development of the ecosystem that let's say, there are many more options for founders here today than it was about 20 years ago?
No, absolutely agree. That's also my perception. And I think it's a great time today to advance science, given those multitude of options. But we all know that will change at some point, because what's different with life sciences compared to tech is indeed that it still takes long, right? I mean, we just because the COVID vaccines have been developed in a record time, there's 15 years of trial and error before, and we were just to a certain degree lucky that at a time where supposedly that platform of mRNAs was ready for success in the clinic. BioNTech and Moderna tried for many years and everything failed. So it's not that there's a new idea, a new cancer approach, a new platform, and you see success overnight. So I think that's the learning curve new investors will have to go through, that unfortunately, opposed to tech, it usually takes quite a long time before we see if something really works out. And so far, I would, as a founder, just take the wave, try to surf on it, as I put in another commentary some time ago. Now, given that there is plenty of money, but I'm sure that there will be a sorting, and there will be a lot of failures in the coming years, naturally. So just having a lot of money available does not mean that you're more successful necessarily, because biology is driving this, and not just the amount of money.
Yeah, I think what you mentioned is coming back to Sequoia, because you said you would like to know a little bit more about that. What I read on the internet was that Sequoia changes their model from a limited time fund, like 8 to 10 years, where they need then to pay off the LPs, to an evergreen structure, which is open-ended, just one fund, and they invest in the industry or in companies for a minimum of 10 years, but just let it run. And if you put it together, what I read, they said that the problem is exactly what you described with BioNTech and Moderna, that great companies and great ideas sometimes need 1, 2, or 3 decades to bring their technology to fruition in a way that it's beneficial for society. And the press release read in my eyes exactly in that way. They said, okay, when an LP invests with us, they must be aware that we are in for the long haul, and we go with the founders through each and every single failure and move that forward. How do you see such models?
Actually, I think it's a great move for Sequoia. I admire the colleagues. They have done great investments over the last 30 years or whenever Sequoia was founded. So constantly great returns. And that is also the basis for this move now, because they have such an amazing portfolio of public companies worth billions of dollars. So they have to do something with this. They cannot just sell their share position, because that would dump the share price. So they had to be creative to a certain degree. And what they did was quite smart, actually. Having this public portfolio where you can invest in, and then they use whatever is generated out of that and put it in private companies and these kind of subsidiary structures. So that's very smart. We'll see if that works out. I'm pretty sure there's a high chance of success, but this is not possible for each and every investor, because you need a substantial basis of investments already, so that with the public portfolio they have, and you need the trust, of course, of the investors that they stay with you. So if you're a new time fund, it's better to show some results relatively early on. Given the track record of Sequoia, people are confident to wait for some years because they have just shown to generate returns. So this is not a model which can be replicated easily by a lot of other investors. And the evergreen fund structure is a great one, but then you also need very patient investors, a big pool of money, like what you have in Denmark with Novo, for example. I mean, they have an evergreen fund structure as well. It's great that we have that, but I still think that the majority of funds will have to show their investors returns in a reasonable time frame, and I don't think that the average pension fund or average insurance company or bank will wait 10 or more years to see if their investment worked out or not.
I completely agree to what you say. I think we should not forget that a core principle of investing is to create returns for investors, and also VCs have investors who invest in their fund.
Yes.
That the fund managers of the VC funds can then invest in companies that create returns for the VC, and the VC can then pay out the returns to their investors. Mm-hmm. When I started in the let's say in the area of before 2015, I sometimes was a little bit let's say jealous because of the digital space. So much money was flowing into that. And one reason was, in my opinion, that the time to a return is much shorter than in life science. Yeah. And my argument always was, if we had so much capital in life science, then flows to the digital space, we could do a lot of more things. And other people said capital is not really a limiting factor. It also needs other things like great entrepreneurs, skilled teams. And this leads me to my next question to you. What, in your opinion, is missing in the European ecosystem currently? Do we still have a lack of capital, or do you feel that other things should be changed in the framework that we operate in, that the industry has a little bit more push forward?
Well, this is a very valid question, but also a constant question for probably, well, as long as the industry exists, because there's always this gap between Europe and North America, and that's not just a geographical gap. It's a cultural gap to a certain degree, and a system gap, which is challenging to overcome to certain degrees when it comes to culture. I mean, in the US, it's just so much more entrepreneurial in general. It's very, very usual or okay for also top academics to start companies. That is still not the norm in Europe. If you speak to the super the best research institutes in Europe, they have clear careers. Those professors, they are incentivized to stay on. They are there. They have lifelong careers with those institutions, and there is, if no incentive, maybe even a disincentive to do something else. So, and that is one element, because we have great science. I repeatedly say that there's great basic science in Europe. We certainly are by no means worse than also the top institutions in North America. But the translation into companies is what's missing. And that's a cultural element, as I'm just saying. Taking risks, seeing failures is something the North American colleagues are just more familiar with, and that's just part of the CV, right? You've done something, you tried something, and well, it didn't work, but you learned something. And then that comes with financial resources as well. I mean, we all know that, unfortunately, success and financial power generates additional success and financial power. So if we don't have too many success stories here, then we lack people investing into new opportunities. So I really hope that, for example, BioNTech is a difference here, because they generate so much money these days, and I see that being dispersed into the ecosystem because they are buying small companies. So a friend of mine just sold his biotech company from Austria to BioNTech last week, and you see that with this now also one success story creates further success story. That's the whole idea of the ecosystem in Boston and Silicon Valley. So maybe we can, to a certain degree, at least replicate that. What we cannot change, same as culture, is that we don't have a NASDAQ here. The capital markets in Europe are not as fluent and significant as the US stock markets. And frankly, for us as TVM, we do not discuss that anymore. We just accept the fact as it is, and will IPO at the Nasdaq if need be. So it's an unfortunate situation, but that's just the reality. So you can do some more here in the European context. We need more public support. We need more role models, more success stories like BioNTech or others. And we can certainly and will have successes here. But I fear that there's just a gap, and there will always be a certain gap to North America.
I couldn't agree more. I think the BioNTech model is great, and it looks also to me that money is flowing back into the ecosystem. So every billion directed to people like the founders of BioNTech who love science and to move science forward, I think is money well invested, because they do what they need to do and they start purchasing smaller companies, and this helps to evolve the ecosystem. Mm-hmm. I also see it similar like you do with the Nasdaq. I think especially in North America, there are much more follow-on funds so that invest in listed companies like ARK funds, for example, Kathy Wood. Mm-hmm. She's also going for European companies, but when I look at her fund structure, I think 90 or 95% of her investments are Nasdaq listed. And I think probably this should encourage European companies also to look towards the Nasdaq when they want to have such an exit. One point you mentioned that I find very interesting, the failure culture. I mean, failure culture, I think, is something that makes scientists perfect entrepreneurs. As far as I understand science, failure and making experiments is part of the scientific process. And I think this mindset is necessary for tech startups to also approach a tech startup in that way, to say, okay, I mean, we try it out, we try things, and what works we keep, and then we approach investors. And I think this is one of the crucial things that I'm interested to hear your opinion. Approaching investors. I didn't know much about it when I started in life science in 2006, and I'm pretty sure I made every single failure myself or every single mistake myself. In your opinion, when a scientist starts a company, what does the scientist need to know? What his company or her company must have that it becomes an attractive target for a VC? How does such a company look like? What are you looking for?
Well, first, I would say, first and foremost, the understanding that you're hardly bringing everything to the table yourself. And there's different people, knowledge, know-how, which should be added to that. So this genius founder who has a Nobel Prize-like invention, and who can build a company of 1,000 staff, IPO that at Nasdaq, found the next company with the next Nobel Prize winning research. That's a rare breed. So, but that's okay. So we all have our strengths and weaknesses, and it's just important to understand where our strengths are, and the weaknesses is something the team can compensate. So if I meet people who are so self-confident that they can do everything by themselves, that's typically a challenging start. Unless, as I'd say, that there's this genius, but as we all know, geniuses are rare. And well, I mean, if they bring that with them, or if they're open to listen, so that we can help those teams or those founders create a company, that's to be seen. But I mean, there are different ways. We started with a single asset model. In that situation, as where we focus on, we don't even need a full team. We just need the idea, and we bring everything to the table from our network. But if you want to create your own small little pharma company, of course, then you should come with a good set of qualifications and different people who have shown in the past that they can create a company and run a company, besides the scientific brilliance, which of course is the basis and the foundation for all these life science ventures, which is slightly different in tech, right? Where also you need good ideas, but maybe that execution is even more relevant. Execution is one element in life sciences, but without scientific brilliance, it's just a me too.
Yeah, that's true. Science and team, I think, is the two key parts that make a great company. And I think also growth potential. How do you see it in TVM? When I look for investments on the public markets, I'm looking for 10x stories or 100x stories, which are not so easy to grasp at the beginning. Like you said, in 2000, there were many Amazons, but only one survived. What is the growth potential that TVM is looking for?
Well, I mean, in that regard, we are not very different to the other investors. In general, we're looking for breakthrough science, and hence a 10x plus return. But we are also okay to have smaller returns if we invest at later stages. So if at that point a company has shown that it can develop a technology that has potentially even brought it to market successfully, and then is now looking for growth financing, which is important and risky in itself. Not necessarily scaling a business is just easy, but this is a different risk portion compared to starting afresh with an idea and no proof yet that this is going to work out. So, of course, also the return expectation is different for these investments.
That's great. It leads me to one question. When people reach out to me from founders of companies or companies that want to do a Series A or Series B, I ask one question. So how long is your runway? And sometimes people say, okay, 2 weeks. And then I say, okay, I think it's a little bit challenging to raise money in 2 weeks, and get sometimes the response, why? I mean, investors, they have money, and it just needs to hook us up and money flows to our bank account. Can you shine a little light on the reality of VC processes, how they work, and how much time someone should implement in their strategy to make sure that they don't run out of money before the VC process closes?
So probably those people who have that idea are misled by the few super success stories, often on the other side of the Atlantic, right, where Mark Zuckerberg is running around and telling that he has this great idea of Facebook, and people just try to be part of that first round, where it's little more than a PowerPoint presentation. Mm-hmm. Of course, there are these situations where it's clear that this is real innovation and it's one of a kind, and there's just one chance to invest. But even in that situation, people are typically part of an ecosystem where they have met before, where they have credible credible contacts who can tell that this is not just some spooky idea on a PowerPoint, but that there's real substance behind. So that's what people tend to oversee, that even if a decision can be made quickly, typically there has been some sort of pre-warming before, and people have spoken and have validated things. So to answer the question more precisely, usually an investment process takes weeks and months to get comfortable with ideas and with the team and the risks associated with that. And if you then just pull the trigger, that might be something which can be relatively quick. But that's a rare situation. And in particular, if you're running out of money, then you get nervous, of course, because if you don't have a check, and well, then what do you do, right? Either you get some sort of bridge, or you have to file for insolvency, and that's then the end of the story. So I would never ever recommend to founders to take that lightheartedly and just go out and say that will just be a matter of a few days or weeks. There's one saying which says, if you, or the day you have raised around, the next fundraising starts. And exactly that's true. So I have many people I'm speaking frequently to who are not raising the next round, but who keep me updated what's going on. So that when they actually decide to raise a new fund, a lot of discussions have happened already, and then this can be shorter, of course. And the same we do with our investors. I do not just go out and say, okay, here's the new fund. We need money now. Please invest. But of course, I mean, there's a warming. They are informed of how the current fund is performing. When we potentially raise a new fund, so we even get slots in their own budgets. It's a long-term play here.
I want to highlight what you said as a final question a little bit more, and ask the question again. In my opinion, there are two philosophical schools on the market. Let's call it that way. So early in my career, I heard never reach out to VCs unless you have something to sell. So don't go out on the market, do your thing, put the presentation together and assume that it takes 6 to 12 months to raise a round. And then you go out to VCs and you make the first contact. Let's call it that way, like Star Trek. So it's like going to a new planet and meeting new people. The other school says successful fundraising is all about relationship management. So you should go out on the market and talk to VCs, get to know them, learn to understand their position on the market, what they are looking for. And eventually, when you are the right match, the process will flow automatically, organically in the direction that it's basically a no-brainer for VC to invest in a company when there is a good fit between the two parties. What is your recommendation to founders? How should they approach this situation to reach out to VCs? What's your opinion?
Actually, for me, these are not two separate ways of handling things, but just looking at the same thing from different sides, so both sides of the coin, if you will. Because of course, how to get attention if you don't have anything to say, or if you don't have a story or have data or something meaningful. And in particular, if you go out and say, okay, just here, FYI, we have an interesting story, but you're not raising fund in the next 4 years. Okay, that might be not the best the best strategy to catch my attention, because then why should I meet with somebody where I don't see any prospect of investing in the next 4 years? But typically there is something to tell, and then you keep indeed the relationships. Okay, this is the data. This is what we have today. This looks super great, but we want to generate additional data to even make the story more round or de-risk further steps? And what do you think would be a next good step? This is our idea. How do you see that? And then come back 3 months later. Now we have generated the data. This is how you generate interest and create relationships. And indeed, as you say, then once the day zero is there to raise additional funds, then you have a much better basis. And it's not happening overnight. So I would say both situations you described are actually true in a certain sense.
Yeah, I agree with that. Progress is always great in a company, and building relationships early probably helps to close the round a little bit quicker than implementing it in the fundraising directly. To also needs to overcome this, let's say, phase of getting to know each other first. Sascha, thank you very much for your time and the great conversation. I enjoyed it very much, and maybe we can catch up in a couple of months and see what came out of our conversation.
Absolutely, I would love to. Unfortunately, this time I was a bit handicapped with my voice, given the cold season. But I'd love to indeed follow up, maybe during summertime a while. So thank you very much, Christian, for the opportunity. It was a great discussion, and let's see how the world evolves around us. I'm sure we have a lot of discussion points next time as well.
I agree with that. Have a great day.
Thank you so much.
Bye. Thanks for listening. Please share the podcast and make sure you've subscribed. Have a great day.